Essentially, there are three possible shapes that we can see in the yield curve. A normal curve has short-term rates lower than long-term rates. An inverted curve has short-term rates that are higher than long-term ones, and a flat curve has short and long-term rates that are roughly the same. In a normal yield curve, the yield on shorter maturities is lower than on higher maturities. The yield curve line curves gradually upward, with the increase of yield decreasing towards longer-dated bonds. The thinking is that the shorter the maturity, the less risk for the investor and, therefore, a lower yield compensation than for longer-dated bonds. A normal-shaped yield curve is usually seen in an economic environment that shows normal growth and limited to no changes in inflation or available credit. The chart on the screen shows the yield curve on March 12, 2010, as the economy was starting to recover from the Great Recession. The curve is fairly steep, which is common early in a recovery period. The S&P 500 chart on the right shows the stock market beginning to recover from its low point the previous year. An inverted yield curve refers to a situation where the shorter-dated bonds offer a higher yield than the longer ones. Despite the name, an inverted yield curve does not have to be completely inverted. Sometimes only parts of the curve are inverted. This can cause humps or dents in the curve as we would expect it to be shaped. An inverted curve is usually seen as a signal that economic growth will soon stabilize or reverse, maybe even signaling the start of a recession. This is caused by investors thinking that the period of economic growth is or will soon be over, making them more likely to accept lower rates before they fall even further. This process can cause partial yield curve inversions. Inverted yield curves are relatively rare. When they do happen, they tend to draw a lot of attention. The example on the screen shows the inverted yield curve on August 24, 2000, in the midst of the dot-com bubble bursting. The S&P 500 chart on the right shows that the stock market began a major downturn around the time of this inversion. When people talk about the yield curve inversion, they usually refer to the 10Y2Y segment. The curve is considered inverted when the 10-year yield is lower than the 2-year yield. We can see that this was the case on August 24, 2000 in the yield curve chart on the screen. Another way of showing that relationship is by drawing a chart of the difference between these two yields, $UST10Y $UST2Y, as shown in the chart on the screen. When this relationship dips on the screen 0, the 10-to-2 curve is inverted. The difference chart shows us that the yield curve was inverted for most of the year 2000, corresponding with the dot-com bubble bursting. When the yield curve is flat, the yields are, more or less, the same across all maturities. This means that you will receive roughly the same compensation for lending your money out for 2 years versus 30 years. You are not compensated for the longer, and therefore, riskier, lending period. As the economy expands and contracts and the yield curve moves from normal to inverted, the curve has to pass the flat shape in both directions. A flat curve can therefore be seen as a transition period in the economy from one phase to another. The chart on the screen shows a fairly flat yield curve on July 16, 2007, a precursor to the Great Recession. The S&P 500 chart on the right shows prices flattening out as the economy transitions from recovery to recession.